So currently what's going on is obviously Africa is seen as the last frontier. We talk about the next billion. And the consumer growth story, which has been in the news and in our lives for years, continues to attract for different industries, whether it's manufacturing, and of course manufacturing needs infrastructure, whether it's for fast-moving consumer goods. These are all industries that attract, and in other parts of the world have grown those economies. So of course now Africa, this is our time, and the fund managers came from all over the world because they now see that there's more opportunity, they're seeing better political stability, better business environment and transparency. So this is our time to move.
So you said there's $1 trillion for investments on the table. How positioned is Africa for that? That's like fund going across the world now. So what share of that cake, if I could use that word, can Africa take based on the current realities and macro indicators?
Well, it's really up to us. So first of all, what I would say is that for private equity is patient capital. And in recent times, people in the market have begun to embrace this patient capital. They realize they require it for scaling their companies. And now these funds from across the world are seeing better opportunity and are then saying, okay, let's see how we can increase our allocation to Africa. But it's up to us in terms of providing a better environment. Of course, again, we need to make sure we have the environment for our businesses to thrive. That means having infrastructure. Energy is a big part of that. Businesses having the energy to perform. And also regulation and transparency. But one of the biggest things that also needs to be considered is that they need to see confidence from local investors. And to date, many of the private equity funds, and this has grown over the last decade and some, have not had enough or sufficient confidence from local investors like insurance companies, pension fund managers, which is what is happening in other geographies around the world. So without that confidence, they can't then give us a bigger share of the cake.
Talking about confidence levels and taking positions, there were analysts who predicted as outlook for 2018 that they were seeing a new style of investments being adopted by pension funds administrators. They called that the barbell investing style, where PE investors basically just looked at the big wins, the quick wins, looked for small business opportunity through big funds in it and then waited to just reap quick cash easily. Was that the reality for last year? That
is indeed not the reality. Private equity, like I said, is patient capital. So we're not in there for quick wins. It's also important to say that private equity as patient capital is there to partner with business owners, there to help them grow. So we're not just bringing cash to the table, we're bringing our broad networks for further financing. We're bringing our networks to talent to help these companies grow well. And we're bringing our experience from other markets in terms of how you scale businesses. And you will agree with me that small businesses are not a quick win. And even some of the large businesses that are scaling for regional integration, intra-Africa trade, those are not big wins. There's still milestones to be met with all these businesses. Perhaps you're talking about those day traders. Private equity is not day trading.
So there are no quick wins anyway. I thought it was alarming too.
There are no quick wins. Again, we are patient capital, and we are sitting alongside the owners of businesses, and we're not even asking them straight away to start repaying some loan, which you might find maybe from bank debt. We are really equity participants and guiding the business owners, mentoring them, providing strategic advice, and really it's in our interest to have aligned interests so that as the businesses grow, that's how private equity does well, and that's how we attract further money from all these fund managers from all over the world that you mentioned earlier.
So I am looking at the latest AVCA data on the value of reported African private equities deals from the year 2013 to 2018, and it did say that last year value of that dropped from $3.5 billion US to in 2017, and that basically just reflected reduced investment activities by both fund managers and investment funds. I'd say, what factors were the PE funds administrators responding to?
Well, the first thing is that, as PE fund managers, we are working in the environment and looking at the environment. And part of that is monitoring when is the best time to enter a transaction or not. We are looking at currency fluctuations because those have an impact on our investments. And as you know, across Africa, there have been currency fluctuations and depressions in various markets. We're looking at how our businesses are faring within a particular environment. That could mean that, you know, is there stability? Is there stability in the markets? Is there political stability? And there have been a number of economies that have had elections this year, and sometimes it's just best for us to wait out and see what the direction is going to go. But overall, what you need to remember is that it's not that private equity moved away from the market, it just didn't grow as much as it grew in previous years.
So what are the specific areas that PE investors are looking to at the moment in Nigeria? So
like I said, consumer industries, again, over 1 billion consumers across the continent. Obviously, energy infrastructure, because businesses need that to run. That's the highest part of the cost structure of businesses. So they need efficient energy so that they can run efficient and stable energy so that they can run their businesses and therefore produce the manufacturing or output or consumer goods that we're talking about. Of course, agribusiness comes into that. Agro-processing is a big area. Some of the essential services, my fund, for example, we're very big on driving financial inclusion across the country, making it easier and more efficient for people to make payments, receive money. So financial services is a big part. Financial services is the oil that keeps the economy going. So we are there to make sure that we can help grow that industry and make it more stable. I've said energy, health, and education. We need a healthy population to be able to have a healthy economy, and we need to educate people. Without education, really, the continent is lost. And so we want to see more money going into educational services and building stronger foundations for the youth of the continent. Financial services is the oil that keeps the economy going. I took that. Now we know that the equities markets have been taking a hit from the macroeconomic indicators so far. You'll get to find out details of that later on the show. Tell me, to what extent is this impacting decisions currently made in the first quarter of the year by PE fund administrators? So, you know, to the extent that equities relates to what we do, we are looking, when we make an investment, we're looking for exits. One channel of making an exit, that is when we come out of a business and we're ready to sell our stake either to the business owner or to others. One channel is the equity market. On a quarter, we don't look at it on a quarter-by-quarter basis to decide where we invest, but to the extent that there's an opportunity to list, which has not been a great channel, because typically that's not the exit alternative. That is our prime channel. But if there is an opportunity to list, we may monitor to see when is the best time to bring that exit to the market, public market. But that's not been the case so far. Tokunboh, thank you for your time and thoughts on the show this morning. You're welcome.